Now, I'd like to introduce today's presenter. He's a fellow of the Association for Chartered Certified Accountants and a director at Davis Grant. Ben specialises in SME businesses, particularly those within the property and recruitment sectors. Ben, together with a number of the Davis Grant team, also have significant specialism within technology and startup sector, exciting sector there, advising innovative clients on R&D tax credits, EIS, EMI, business plans, cash flow forecasting, and cash management. Please allow me to welcome Ben Chernoff. Are you there, Ben?
I'm here. Thanks, Nick. Thanks for the introduction. Right, just want to start off and say good morning to everyone. I wish you and all your families the best of health, and let's get started. So why now? Why are we talking about the end of tax year, financial year, and to plan ahead? And as you may or might not know, the tax year runs to the 5th of April. And really, it's important to start probably from January for the last few months of the year to have a look at what reliefs are available, what allowances are available, and make sure you're taking advantage of these. There's lots of steps that you need to take to try and reduce your tax bill, but you need to make sure you get them right, because if you don't get them right and you think you are getting released when you're not, you could be hit with an even bigger tax bill than you expected. There's also a few upcoming changes that are coming from March and April this year that we're going to touch on at the end of the webinar. So there might be a few points for you to take away from that. I think with the budget that's right around the corner, and as we all know and hear, there's most likely going to be tax rises not too far away. I think right now is really a good time for you to start looking at how you can save your tax bill and be as efficient as possible. You may or might not know, but the biggest hint that we've had is that there's going to be capital gains tax rises, and therefore you may look at the next few months to try and take some of your gains and pay the tax that you need to pay now, or make a capital gain up to your annual allowance, but we'll come to that shortly. So we're going to start off with business tax. So businesses and their owners need to consider their current position in regards to the following before the year end. So dividends. So every individual gets a £2,000 a year dividend tax nil rate band. So if you haven't received a dividend this year and you are a shareholder in a company, or you've got family members that have shares in your company, why don't you look at giving them a £2,000 as long as you've got the reserves to take those dividends, and they won't pay a penny of tax on that. If you miss this tax year and you submit the tax return for 2021, you can't then carry that forward, the £2,000 allowance, to the following year. So that needs to be used each year. The same with the capital gains annual exemption. You get £12,300 each year to make a gain, and again, you don't pay any tax. So if, for example, let's say you have some shares and you have, I don't know, £50,000 worth of gains in those shares, you could decide, okay, I want to take some of those gains, sell up to £12,300 worth, and not pay a penny of tax on those gains. Business asset disposal relief, so entrepreneurs relief. This has been heavily attacked the last couple of years and has had a lot of negative press. And last year it was reduced from a £10 million annual lifetime allowance to £1 million. And to get entrepreneurs relief, this is effectively selling shares in a trading business that you own over a certain amount, and you might need to make sure that within 2 years you're not restarting up a business in that same industry. But again, there's a lot of rumours that this could be further attacked by the Chancellor, and therefore if you are in the process of selling a business or closing down a business, you might want to try and get this through as soon as possible. And the last point, incorporation. So there are a lot of tax advantages by being a limited company. Again, this may be something you want to try and get in this year in case that in the budget or later down the line, the Chancellor adjusts the tax efficient structure to becoming into a limited company. Over the last few years, us at Davis Grant have been incorporating a lot of property portfolios, and some of the incorporations can take up to 3 tax years. So if you effectively start the incorporation before the end of this tax year, you can effectively get a year head start. And if you do have a property portfolio, please do get in touch, because that is something we can assist with. Corporation tax relief. So as a business, you pay corporation tax, and there are a few main things to look at kind of at the end of your financial year, but it's relevant looking at the end of the tax year as well. So they announced at the back end of last year that the AIA allowance, the annual investment allowance for capital allowances, is now going to remain at £1 million. So that means a business can effectively buy assets, fixed assets, for the business up to £1 million and get full tax relief on those assets. So let's say you buy something for 100,000, you'll get 19% on the full 100,000 tax relief. R&D tax credits. Again, we've been submitting R&D tax credits for our clients for about the last 10 years. And businesses last year claimed over £5 billion back from HMRC. So do you have any projects that are potentially R&D? Even if you're not 100%, please just give one of us a call, either your director or manager that looks after your Davis grant, and we can have those conversations to see if there's anything you can potentially claim. Now with R&D, some people don't know that you can actually go back and you have 2 years to submit your R&D claim from the end of your accounting period. So if we looked at it and you have R&D that you can claim, and depending on the timing, we can potentially go back and do your last 2 years R&D tax credits, and therefore potentially either get tax back that you paid, or if you were loss making, also get your tax credit. And lastly, the patent box. Again, if you make profits for patent inventions or IP, there's potentially some tax credits we can also look at getting you back from HMRC. I think the other point just to make onto corporation tax is if you make company pension contributions, or you don't and you potentially want to make company pension contributions, that to be able to get tax relief on these, they need to be actually paid to the pension before the end of your accounting period. So if your accounting period runs to the 31st of March and you want to make a £10,000 pension contribution to get 19% corporation tax relief on that, you need to have made the payment before the end of March. So again, if you are coming up to the end of your accounting year, speak to your accountant, speak to us, speak to your financial advisor, and get the ball rolling. Personal tax. So obviously we're coming to the end of the 5th of April for your personal tax returns. Just a few things to think of here to try and reduce your personal tax bill. So if you're earning between 100 and 125,000, the effective rate of tax in this band is about 65%. Because you lose your personal allowance, you lose £1 for every £2 you earn, and therefore you can potentially transfer some of your between husband and wife. You can transfer some of your allowances to increase the amount of allowances the higher earner will receive. Again, please speak to us if you're not sure how that works. Salary versus benefit. So again, this could be a really good way of saving some tax. So this is more relevant for the higher earners out there. But what you can do, if you're employed and let's say you earn 100,000 a year, and it's coming to March, and you're due a big pay slip or you're due a bonus, you could potentially ask your employer to, instead of paying that bonus to you as additional income, whether they would pay that direct into a pension. And what that will mean is, instead of obviously you being taxed PAYE and national insurance, that will go straight into your pension. And therefore, if your income was going to go, say, from 100 to 110,000, and you would be taxed at roughly 65%, your income will stay at 100,000, and you'll also get tax relief on the money going into the pension. And lastly, inheritance tax we're going to touch on also today. But this requires some careful planning looking at your estate and wills and trusts. So again, we'll touch on that shortly. Oh, so inheritance tax, here we go. So yeah, the number of families affected by inheritance tax is increasing greatly, even though the government have increased effectively the tax-free band up to £1 million for husband and wife. With the value of properties increasing so much over the last 10 to 20 years, a lot of people, that £1 million is taken up, the vast majority, by their residential home, and therefore any other assets they're leaving will be taxed at 40%. So just a few points to touch on. So charitable gifts, so you can leave up to 10% of your net estate to a charity, and that reduces the rate to 36% rather than 40%. Gifts to family and friends. So if you're looking ahead and you're of the older generation, if you make gifts and you live at least 7 years, then those gifts are passed out of your estate. If you die within the 7 years, depending on how far has gone, that relief is tapered off. But again, this is something you should definitely start looking at. Passing on your pension. So please, you need to make sure you've updated your will, the full, so who your pension goes to. One thing to touch on is that if you die before you're 75, your pension passes on tax-free. And if you pass away after 75, the beneficiaries will pay tax at the marginal rate. And therefore, really, if you do not need to touch your pension and you have other assets or other income, you should touch that first and leave the pension till last until you really need to touch it. And trusts, again, there's a number of ways to gift assets into trusts. This is especially relevant for investment businesses, and therefore, again, please speak to your financial advisor to discuss any trust that you might want to bring into play. Personal tax allowances. So there's two main allowances. Obviously, we know you get your £12,500 a year for earned income, which hopefully won't get attacked in the budget, but the government, I think they're going to keep that £12,500. You also get a lifetime allowance for pensions, which is currently just over £1 million. And once you hit that lifetime allowance, you really need to be careful, because effectively you start getting taxed on top of putting money into your pension. In terms of how much you can put into your pension each year, so you can, at the moment, you can put in £40,000 a year tax-free into your pension. Now, from 2021 tax year, if your income goes over 240,000, that 40,000 is tapered down to a minimum of £4,000 if your income is over 312,000. However, you can use 3 years brought forward annual allowances. So if for the previous years you've been earning, let's say 100,000, and you have a 40,000 annual allowance, or sorry, annual pension tax-free allowance, you can use that and make a large contribution in the next year. So just some more points on pensions. When you hit 55, you can draw down 25% of your pension tax-free. Again, depending what other income and assets, you might think, actually, I want to leave that because I don't need that money right now. And as I said, later down in life, that might be outside of your estate in terms of inheritance tax. Pension contribution made to employees by an employer are tax-free. So you can also claim business tax reduction against that. And also, all children can also have a junior pension and make up to £2,880 per year, which then gets topped up by an extra 40% on top, 20 to 40% on top of that. So you can start a junior pension for your child from birth, and this could be a really good tax efficient way of saving for their future. So just a few tax efficient investments for you to look at. I think most people know of an ISA, and you can have £20,000 paid into an ISA a year, and any gains or interest earned in your ISA is tax free. So you can look at things like the Help to Buy ISA, the Stocks and Shares ISA, and also the Child's ISA. So you could potentially for your children have a junior pension and a Child's ISA, which is two really good tax efficient ways to start saving for their future. But there's also other things to look at. So whether you want to look at any investments, so from an EIS and SEIS perspective, and if you do make investments into these types of schemes, you can potentially get between 30 and 50% of tax relief on those investments. So if you want to try and reduce your tax bill and you're also looking to make investments into these types of businesses, again, please speak to your advisor and they can go through that with you further. There's also just a few other different types of investments there, like venture capital trusts and life assurance bonds. Just a reminder, if you are planning on investing on any of those schemes, please do make sure that you speak to an independent financial advisor along with getting the tax relief, because you want to make sure you're putting your money in the right place and also where you're putting it is going to work for you. So there's two big tax changes that are coming, one from the 1st of March and one from the 1st of April. And I'm just going to touch on these briefly. So one is on the IR35, which is known as the off-payroll rules, and the other is on the VAT Reverse Charge rules that's coming in for the construction industry from the start of next month. So just going to start on IR35. So this has been around for a while, IR35, and what we're talking about here is effectively a company engaging a contractor to work for them, and who is determined whether they should be a contractor and therefore not deduct tax, PAYE and national insurance, or whether they should be an employee and deducted PAYE and national insurance. And what the changes that are coming in play from April is that who the responsibility on is changing. So this was delayed from last year. And what this means is if you're a medium or large business, it's not yet in play for small businesses, which will affect the majority of our clients. But if you are a medium or large size business, this is going to affect you. And what this means is that the determination of whether they're going to be a contractor and within the IR35 rules is now putting the responsibility on the company itself. So let's say you're a medium-sized business and you've got various contractors working for you. You need to review all of those contracts and make sure that you are comfortable that they should be contractors and not meet the criteria to be employees. And there is a really good, there's a good tool on the Revenue website that basically takes you through a load of questions, and it tells you based on your answers whether they meet the rules for an employee or meet the rules for being a contractor. If they are in the IR35 rules, it doesn't mean they have to go on the payroll. You can still pay them through their own company. But what that does mean is that you need to deduct PAYE and national insurance on their payments to that company. So again, this is a big change, and why it's important is because if these medium and large companies do not check this out and the Revenue challenge it, they would then be liable for the tax and the PAYE, even though they've paid the full amount over to the contractor. So just a reminder on the criteria for a medium company, it's 2 or more of annual turnover more than 10.2 million, gross assets of 5.1 million. So this is gross assets of fixed and current assets, and it doesn't take into account any of your liabilities, and employees is 50 or more. So just to go on some steps that a business can take to help them. So like I said, you should do an audit of your freelancers and contractors, determine which ones fall under the rules, communicate all the changes to them and create an agreement. And lastly, consider any additional costs and how that is going to affect the service they are providing to you. So the last thing I'm going to talk about is on the VAT reverse charge. And this is a big change for the construction industry. Again, this was delayed from last year, but this is now coming into play from the 1st of March. And what this means is if you are a contractor, so you worked for a main contractor, and previously you would invoice them. Let's say you would invoice them £10,000 a month, and you would then charge them VAT. So you would invoice them £10,000 plus £2,000 of VAT, and they would pay you over £12,000. Now, what this means is that effectively you would just be invoicing them £10,000 and no longer be charging them the VAT. And what this is trying to stop is subcontractors that are out there charging VAT, receiving that VAT from the main contractor, and then not paying that VAT over to HMRC. And you've got the main contractor who is trying to claim the VAT back from HMRC. So yeah, it's going to be a major way that the construction industry is invoicing and submitting their VAT returns. So it's an extension of the existing CIS scheme, which all the contractors should already be making deductions for income tax and national insurance from payments to their subcontractors. So if you are in the CIS scheme and you either get deducted at 20% or 30%, depending if you've been registered correctly, this is going to affect you. So should you be registered for CIS? Most landlords, property developers, tenants are exempt, but it's worth checking if you employ a lot of subcontractors for building works. If you pay subcontractors for construction work, and your average spend is more than £1 million a year on construction within any 3-year period, then you need to register for CIS. So let's say you're a property developer and you spend on average more than £1 million a year in a 3-year period, then even though you might think you don't need to register for CIS, you do. You need to make the following changes. So you need to adjust your invoicing and accounting procedures to take into account the reverse charge VAT. So just to cover on this, what this means for the main contractor is basically on the subcontractors' invoices, they will need to now account for the VAT as a reverse charge basis. So that, going back to my example, £10,000 plus £2,000 of VAT, they'll pay to the subcontractor the £10,000, not including the £2,000 VAT, and they will put into box 1 and box 4 of their VAT return the £2,000. So the net cost to them is nil. It's effectively coming in and out, and this happens on how the reverse charge treatment used to be, and that's so they need to make sure their accounting procedures take this into account. You need to communicate with others in the supply chain to consider how the rules apply to them. Consider any cash flow implications of the new business. Of course, the subcontractors previously, if you were invoicing £10,000 plus £2,000 VAT, you would get that VAT money and you wouldn't potentially have to pay it over for 3-4 months later down the line. And obviously now you're not going to be receiving that VAT money to potentially use before you have to pay it. And lastly, take time to identify which suppliers are affected and possibly any end users that might also be affected. So I think that is our last slide. So I'm going to pass over to Nick now to go through any questions we've had and take it from there.
Thank you very much, Ben. That was really informative, and I'm sure everyone in attendance would want me to thank you for sharing all your insight there. Really brilliant. A lot of technical detail. I know as a layperson, there are a lot of 3-letter acronyms and things to get to grips with there. So anyone who does have any specific questions, we have had a couple of specific questions. I'm going to ask a general question now, just to give anyone who has any follow-up questions, please just click that Q&A button and get them in. We've got a couple of minutes to answer your questions. But Ben, I was thinking in general terms when we were watching that there's a lot of technical detail there, and for the audience, they might be worrying, okay, or thinking, well, what can I do about it? I mean, yes, we're aware that there's a lot of people on the webinar today are existing Davis Grant clients, but there might also be people who, you know, don't work directly with us. And so what's your message to them to kind of say, you know, what they should be thinking about? What, you know, they might be saying, well, all this stuff is great, but that's what I employ you to do. What's your answer to that?
I think accountants have always had kind of a name for always being looking at historic information and not being offering proactive advice. And I think especially when we've got clients, if they're personal tax return clients, they always leave their tax return down to the last minute, and we don't receive their information to December, January when it needs to be filed. And again, for companies, we act for numerous companies, and we might not receive their accounting records for six to 9 months after the year end. And I think what we try to push at Davis Grant is to speak to us even before the end of your period, to be able to put these things into action. So if you're a personal tax client and you're worried about how much tax you might have to pay this year, call your tax advisor and say, this is where I'm at currently, this is where my income is at currently. What things can I look at doing in the next couple of months? So next January, when I have my tax bill, I know that I've tried to reduce that as much as possible. The same where it comes to companies, for a lot of our bigger clients, we have pre-year end meetings with them. And these are the types of things that we will go through with them to see, right, can we make any company pension contributions with them? Is there any big fixed asset additions you need to do over the next few months? And we can bring that forward to try and get the tax relief on them. So I think the key point there is be speaking to your tax advisors, and don't wait to 6 months after the period's finished and then think, oh, why didn't you help me with this then? When they probably most likely did try and get in contact with you and you just kind of didn't at the time kind of want to look at it.
Okay, so yeah, so the message is clear that you really kind of, by looking ahead and by having those conversations, and that's something that we really want to do with you at Davis Grant, you know, pick up the phone, have a chat through things ahead of time just to explore those issues, because your accountant can't be a mind reader, and really that dialogue will help everyone involved just to identify any opportunities that you might have, and to really look forward and be proactive with those opportunities. And that's why we're doing this webinar, really, to highlight those potential things. So really, our hope is that, you know, one of these things that Ben mentioned in the presentation might trigger off, maybe it was pensions. I felt there was some really good stuff about contributing to pensions in there, and potentially looking forward to the budget as well, kind of looking and planning ahead. So we have got a question come in about IR35, and I guess the question that I also had for you, Ben, was you were talking about how it affects kind of the medium and large businesses who employ those freelancers or people who, you know, off payroll workers. And I guess the follow-up question is, how does this potentially affect those off payroll workers? So if I'm a freelancer who uses a limited company to invoice an employer, what are the potential impacts on me?
Yeah, I think that's a really good question, and I didn't touch on that. I was looking at more from the company itself point of view. But if you are an off payroll worker, you need to be having those conversations really as soon as possible with the companies you work for. And look, having your own company, or whether you're self-employed, really, if you only work for one company, it's most likely that you probably should be an employee. If you work for numerous companies, obviously there's a lot more to it than just working for 1 or 5 or 10 different companies. But if you work for a few different companies, and you think actually this could affect you, make sure that the company you're working for is running it through the HMRC online system. If they say yes, you are in or you're out, ask them for a copy of the answers and make sure that you're happy with the answers they have put on there. And I think if it ends up that actually you need to be in IR35 and therefore POA national insurance needs to be deducted, you might actually look at it and think, well, there's no point me running this through a limited company anymore. I might as well become an employee and get the benefits of an employee, such as holiday pay and sick pay. And therefore, these are the types of conversations that you should be having kind of straight away, because it comes in from the start of April. You don't want to 3-4 months down the line, after they've started deducting POA and national insurance, be thinking, oh, I'm actually a lot worse off here. And start having those conversations. Then you should bring that forward and start speaking to the companies you work for now.
Yeah, so that potentially will change things. And I think I picked up on there, the distinction is if you're working exclusively or primarily for that company. Is that right, Ben?
Yeah, well, look, there's a lot more to it than that, but
yeah.
Like I said, there's whether you can provide a substitute or they provide the equipment. There's a load of stuff what it comes to when we look at IR35.
It's a detailed conversation.
Exactly.
And there's a specific question here from an anonymous attendee. If I'm a small company, do I need to worry about IR35? My turnover is less than 1 million.
So yeah, so the new rule, I mean, IR35 is there currently for all size businesses. What is changing is who it's putting the responsibility on. So for medium and large companies, it's now putting the responsibility on them. If you're a small company, the responsibility is still on the contractor to determine whether they think they should be an employee or a contractor. So I'm not saying that you don't need to worry about it, because all businesses employing contractors should have had these conversations when they started to give the cert to employ these contractors or to have them provided a service. But you need to be less worried in terms of who the responsibility and who any potential liability could be on if you're a small company.
Thank you, Ben. We've got a couple of questions about the construction industry scheme and reverse charge VAT, but I'd like to come back to those because I'm aware that they're quite, that and both IR35 have been quite specific. So there's a general question which is just more around uncertainty in these times, where I'm aware that like a lot of our presentation was like, you know, if you've got a lot of income or if you're in the higher band, or, you know, how to move things around. I would say, what would you say to people who are kind of concerned about maybe they've found their revenue dropped off a cliff due to the pandemic or things like that?
Yeah, so look,
to them?
I think the last year has been challenging for all individuals and businesses for different reasons. And I think, correct, there's obviously a huge amount of people that have seen their income drop considerably. And they're more interested in just making sure they've got money than looking at these types of things. But I think even if you're struggling and your income has dropped considerably, you don't want to then be hit with a big tax bill because you haven't been doing these things to be able to reduce that. So whilst a lot of the tax savings are more advantageous the more money you earn, they still affect a lot of the kind of lower to medium earners as well. So I think you should still be having these conversations, still be looking at where you can be tax efficient. And again, if it's not tax savings or being tax efficient, speak to us about whether you want to get a bounce back loan, or you need to get a C-bill, or you need help deferring your VAT or deferring your self-assessment. These are the types of things that us being your advisor can help you with. We don't just looking at the tax savings and the bans and this kind of stuff. It's more general advice, and there's a lot of other ways we can support you.
Yeah, I'd second that. I would really say, you know, what we were saying earlier at the beginning of the Q&A is true, which is just, you know, you'll only benefit from having those conversations with your accountant, with your team member at Davis Grant, whether things are going well, things are going badly, or you're just uncertain. you know, our ethos is, and I can understand there might be people worried or isolated at the moment and not really knowing what to do. You know, we're here and we've been open throughout the pandemic. In fact, if anything, we've been busier and we've actually expanded our team. So we are here. So now a couple of stuff, some stuff about the construction industry and reverse charge VAT. I'm aware that we're going to have a lot of stuff coming out about this next month as well. So there will be more information on the way. But there's a couple of specific questions. One from Neil about whether as a supplier of kitchens to a developer, are they considered the end user and then the reverse charge doesn't apply? I might say, Neil, as I know I'm aware you're a client, probably that's something that we can follow up with you afterwards. And there's another question about if I only work with residential customers, do the new CIS rules affect me? Do you have anything to add there, Ben?
On the first point with Neil and kitchens, I think, yeah, I'll speak to Neil off this webinar just to run through, because with the CIS rules, there's a lot of technicalities about who's in and who's out. And yeah, I'll need to go through exactly how you're currently operating to see if that affects you. If you're only providing to residential and you're not contracting, then yeah, you would, if you're just selling, let's say, kitchens to the end user, then this wouldn't affect you, because you're just selling them. Let's say you sell them a kitchen for £10,000 plus VAT, you're still charging the £10,000 plus VAT. So this won't affect those types of sales. This is only if you've got a contractor and a subcontractor, and the subcontractor is invoicing the main contractor. This is what this is going to affect.
Yeah, I think that's a really good distinction to make from my layperson's perspective, is that the construction industry scheme is quite specific about that kind of relationship between contractors and subcontractors, and there is also a comprehensive list of the kind of works that can be included and those that can't. And as Ben said in the presentation, it means that a lot of standard kind of property-based trades and development work is actually outside of the scope of the scheme. But it's definitely worth double checking that, getting in contact and doing that. I would note as well that the construction industry scheme is not necessarily a new thing. The VAT element is
correct.
new,
Yeah,
so.
the CIS has been around for years and years. It's the reverse charge element that's coming in that's new. And like I said earlier, it's really to stop those kind of rogue subcontractors charging VAT and never paying it over to HMRC. That's why they're trying to bring this in. It's not to stop your kitchen provider or your decorator going around to someone's house and if they are VAT registered, not charging the VAT. That's not what this is for.
Understood. Thanks, Ben. Okay, I think we're getting towards the end of our time there, so thank you very much. I guess there's one last thing I would say is that Ben did mention, particularly at the beginning of the presentation, about the upcoming budget that's going to happen in the next few weeks, and there's lots of talk about potential tax rises or and we just don't, at this point, everything's moving quickly. But I would say with the budget is that published today will be our review of what potentially could be expected with sources from respected media, so you can get a look at what might happen. And certainly, please do subscribe to our newsletters at davisgrant.co.uk/subscribe, where we will, we get news out as quickly as we can. And try and filter it and present it in a way that we know will be meaningful to you, our valued clients and people in the space of kind of SME businesses. Thank you very much. Ben, do you have anything to round up?
No, just to finish, yeah, like we've said all the way through this webinar, it's really important, especially with what's going on at the moment, to stay in contact with your advisors. And especially here at Davis Grant, we're here to help our clients as much as possible and help them through these hard times. So stay in contact with your main point of contact. And if anyone needs any help or any questions, please just get in contact with us.
Thank you very much, everyone. As Ben says, do keep in touch. Contact us with the details on the screen if anything comes up or you need any additional help. Thank you very much, and thank you.
Cheers, thanks.
Bye-bye.